for joining us today. This is Hall Martin with 10 Capital. Glad to join us for our Ask Me Anything monthly session. What we'd like to do is read and answer the questions that have been submitted so far and invite you to submit your own questions as well through the chat box or the Q&A section as well. So if you could, locate those, and as we're talking, if a question comes to mind, go ahead and submit it, and we'll do our best to answer it here today. With that, we'll go ahead and kick off. I want to thank you guys for joining us. And our first question is from Jack. The question is, what are the economics of investing in climate change solutions? Well, Jack, I think climate tech is going to be one of the biggest areas for investment in the next 10 years. It's winnable. From the COVID-19 experience, in which pollution quickly came down in various areas, I think people got a vision that if we do limit what we do in the world, we can change the amount of pollution in the world, and we can win the climate change situation. Also, climate change for many people is becoming more real. Venice is going underwater, Australia is on fire, and people are starting to see that this is a real issue. When it becomes real, that means money becomes available, and that's when we see investors and startups show up to start to engage. Key with climate tech is with any large-scale investment like that is to focus on scalable use of technology. In 2010, there was quite a bit of effort after renewable energies, which is not that different from carbon sequestration and other climate change technology issues. And what I received back then were requests for $10 to $20 million to do a seed level prototype. And the challenge with that is that was just too much money. It was just too expensive. You're going to have to learn how to prove out your technology in a much lower cost, more simpler way to demonstrate that it works without doing it at scale. What you need to do is start to work with corporations and governments to do the scale up projects as well. So one of the things you want to consider is licensing as a go-to-market strategy. Instead of building the product or providing the service, you want to create the core recipes, technologies, and other tools that lets other people go and implement it, because a lot of this is going to have to be implemented at the government level. It's just too big and broad to think that venture capital and angels are going to be able to fund it all the way that are there. Another thing you want to do is build out a partnership ecosystem. These are big projects, and so you need corporations, governments, and partners to help you get there. And so what you want to consider is perhaps launch a platform to connect all the players together. From a startup point of view and from a new technology point of view, that's a great way to build your network and your community. So that's my question there, Jack, and looking forward to any follow-up questions you may have at the end of this session. Next question is up from Jennifer. Jennifer says, we are in the stage of preparing to join a startup accelerator program to redefine our business model and get funding to set up technology that would make our services more accessible and affordable to small businesses and entrepreneurs. And so we need to prepare to undertake that challenge and are trying to get better educated on how we can take our business to that next level of vision that we have. So Jennifer, my recommendation is, in joining Accelerator, make sure you know what specific support you are looking for. Are you looking for domain knowledge, business model expertise, go-to-market strategies, or other? Look for accelerators who have the people you need. Don't ask what content you'll be receiving, since the content is typically generic. Instead, ask who will be mentoring and research those people to learn about their experience. Ask about how much time you'll receive from those people and relevant to your goals. And here's a key thing, get it in writing. You're typically giving up a substantial amount of equity, and you don't want to do that for plain vanilla slide decks, which you can find on the web. In conclusion, know what help you are looking for and find the right people who can provide it. Let's check and see how we're doing, if there's any questions at this point. Let's see. So Jack's follow-up question is, what's the ideal appropriate scale of proof of concept round? So Jack, the thing you have to bring is that, number one, the technology works at not just a benchtop level, but at a small or medium size level, not a full production level, but something that is more than just a lab prototype. You have to demonstrate that you can scale this up at some level that is above what can be done on a desktop, but less than what requires something to cover, say, the state of Wyoming. There's a middle ground in there for doing a test. That's where corporate partnerships really come in handy, as a lot of corporations have tools and systems in place already where you're going to be gliding off of that. You're going to be another desk in that group to show how your technology is working and gather existing data. Partners who have access to those systems or those chemicals or those materials, that's who you want to go and work with. What you can do is organize a licensing arrangement with them. They get a reduced cost of the license if they help you with the product validation, the market validation. So something that a corporation would sign up for say a 3 to 6 month partnership or program is about the level that we're looking for. So that's the answer to that question there. Let's go on to the next question. Whoops, let's go back one. Next question is up from Justin. Justin writes, I just left a company that is in peak high growth phase. After a successful run ending with multiple years on the leadership team, I knew it was time to get back into an earlier stage company. This time I do not have the next thing lined up yet. That said, I'm trying to ingest as much startup and entrepreneurial content as possible since I want to land in this world again. So Justin, thank you for the update. Glad to hear you're doing well there. There's no shortage of startups out there, and it's not hard to stay up on things given the number of meetups, pitch sessions, and other events. My recommendation is, as you look for your next project, is make a list of what you liked most about your previous startup. Where did you find that you could give the best contribution? Define the startups based on revenue, sector, stage, etc., that you can help the most, and how can you help them? Investing, advising, mentoring, leading, and if leading, what role? Find out where those startups are meeting and engaging in and hang out there. Or offer coaching, research, and other forms of support at no charge to build a network and demonstrate your value. So the key is to figure out who you want to see. One of the biggest challenges you have in the startup world is that there are so many kinds of startups. There are tech startups, scalable startups, lifestyle businesses, home startups, diversity plays. There's so many different sectors and so forth that you really want to start narrowing it down. You can spend your entire life networking with thousands of different groups, but chances are that only 10% of those are going to be relevant to what you're doing. So you want to define that up front as to what is relevant, what do you think is the target, and then go after those guys as well. Next question up is from Michael. Michael, thanks. I'm currently in business school at McCombs working on launching a business, so I'm looking for general best practices about seeking outside capital and building the necessary relationships. So Michael, it's great to see you put relationship in the question, as it's a key part of raising funding and starting a business. In fact, you start with a relationship and you move to fundraising later. So my recommendation, Michael, is provide value to the relationships you want to build. Don't create empty networking relationships. I've been working in the startup community for over 20 years now, and I've sat through an enormous number of coffees with people who wanted to network, but didn't really know for what purpose. Instead, build real relationships. Figure out what areas of interest you have and perform research on those areas of interest. For example, you may notice a key contact you want to meet invests in fintech. Perform some research on fintech and offer to share the results with them over a phone call. Make it short on time but rich on value. It's quality over quantity when you build relationships. Again, Michael, thank you for your question there. Let's go to the next one. Next one is Mark. Mark's question is, what advice do you have for startups seeking seed capital funding in 2020 given the current economic climate? I'm sure there are others interested in this topic. Mark, that's a great question, and I get a lot of that these days. So number one, investors are still out there in force. There's a misconception that investors aren't writing checks. Oh no, investors are writing checks. They're just writing them in a little bit different way. I estimate 75% of the investors are doing business as normal, 20% are slowing down, and 5% are stopping because they're just distracted by the gyrations of the stock market. In another few months, that's probably going to settle out, and they'll get back to it as well. In the first 4 weeks of the lockdown, I found that most investors were preoccupied with their portfolio companies. They were there trying to obtain PPP loans, provide follow-on funding, triage the ones that are going to make it versus those that are not. And for the most part, that part's done. It's over. Now they're looking for businesses that are COVID-proof. If you can do well in a COVID economy where we are, then you will find investors interested. COVID essentially accelerated certain parts of the economy, and what you'll find is that that's probably a proxy for what's going to do well in the future after COVID is over. So now is the best time to start a business. Costs are low. We're at a new inflection point. That means the market has a new set of care-abouts that the competition is not yet servicing. As always, bring product validation and market validation. Product works and people will pay for it. Contact provincial customers to discuss their needs and concerns, and every conversation with an investor, bring up what the customer is saying. Most startups build a product first and then they find the customer later. My model is sell it first and build it second. In fact, the best proof you can bring an investor is a customer who will prepay for the product. You don't have to pay for it completely, but it shows you have market validation. So Mark, good luck with it, and I hope you get your startup up and going in this market, because now is a great time to do so. Next up is a question from Russ. Russ asks, what are 10's greater economic assumptions of the next few months and years? A devastating depression, a quick V recovery, or anything in between? So Russ, thank you for the question there. My answer is there are two economies going on here, not just one. There's the online cloud economy, and then there's the offline brick and mortar economy. The former continues with great acceleration in the lockdown. The latter is all the bad news that you hear on the evening news. Some say we're at an economic depression. It's an economic depression for the old style brick and mortar and for old just-in-time inventory systems, but it's full speed ahead for anything online in content engagement. The stock market continues to move up after a short correction of 20%. This is because the correction comes from the market recognizing how overvalued the market was. Crunchbase did a survey of investors before COVID and found that most thought the market in the startup world was overvalued by 30%. So in market corrections, it's going to get readjusted back down. I think we'll see a 20% correction overall coming in the startup sector itself. In the next 2 years, what we're going to see is a shift from old economy allocations. Retail, real estate, and just-in-time supply chains are going to give way to the new economy allocation, which will be online, work from home, and secure supply chains or robust supply chains. The former will continue to drop and the latter will continue to rise. And if you go back and look at every crash, this always happens. In the short run, it's very painful to see those jobs go away, but in the long run, it's best because those people will get new and better jobs that are more appropriate for the future. As far as VC funding, it's not going to dry up. Currently, there's a flight to safety. The best deals are getting funded now. And a new investment thesis will start to appear shortly, and you'll see an expansion of VC funding over the next few years. They'll get back into it in a bigger way. And as far as reactions to the potential opportunity from Congress, where they're talking about putting in funding, government funding for startups outside Silicon Valley and New York. My reaction is I've seen government funding before. It's helpful to have a matching funding from the government, but government funding tends to be a one-shot. It doesn't keep going. You must have a startup that can continue to command follow-on rounds of funding. It's helpful, but government funding is not as helpful as you think it is. And last question is, are there any virtues for a young company to proactively tokenize their cap table or keep it simple with spreadsheets? And from an investor's perspective, I don't see a benefit of tokenizing the cap table. I've not met many investors that are looking for that. In fact, I've not met any. Most investors are still leery of the token models, and the regulatory is still a long ways from being settled. I wouldn't spend too much time on that right now. So next question is, are there any entrepreneurial trends you or other VCs you know tend to smirk at? And so the one I always laugh at is the world is coming to an end scenario. If you listen to the news, the world's going to end tomorrow and there's not going to be any future. All those people that left jobs are going to be looking for new ones, and there's going to be plenty of talent to go around. So I think we're seeing the old economy going away and the new one is not yet fully in place, but the new economy will be better. What I think you're going to see in the next generation is you're going to see manufacturing return to the US. You're going to see them trade off a low-cost labor force for a secure supply chain. You can see the rise of automation, AI, and robotics, and it will be welcome. Remember 6 months ago, AI and robotics, they were coming to take our job, and in today's world, it's a must-have because you have to replace workers that are in quarantine. We'll see a trade-off in just-in-time inventory for a robust inventory system, something that never runs out. All these points, can look for opportunities to in startups to provide in the future. So envision what the future will look like and start building the parts that don't yet exist, because we're at a changing point now where the old world is switched and it's a new starting point for all of the companies out there. Next one up is from Chen Liang. Chen, thank you for your question. The VC market, the question is, I don't have specific questions at this moment. I'm in Houston right now trying to figure out what the local VC market is like. So I guess the question is, what's the local VC market like? The VC market continues as always. Most VCs raise their funding so it's in the bank and they're continuing business as usual. In today's market, they're looking for better valuations and better companies. You'll see quotes about how great companies started in economic downturns, and this will be no different. What will come out of the next 12, 18 months will be some of the best companies you'll ever see in 10 years from now. Cost of starting a business is low and labor is plentiful. Customers have a new setup and care about for the things that they want to see, and so it's timely to start a business. As far as the local VC community in Houston and Texas, what you'll find is that there's about a dozen VCs in each of the major cities, Austin, Dallas, Houston. And there's one thing you'll find in Texas is that there's most of the money is not in VC form, it's in family office form. So if you're in Texas looking for funding, you want to think family office. You'll find also family offices can be deeper pockets. They're not limited to a 10-year model, and they tend to be much more reflective of your business if the founders, if the family office came from the industry that you're in. So you're looking for family offices that know your industry and can help you, and you'll find that a great way to raise funding in addition to the VCs that are there. Yes, there are VCs, there are angels, but the family office is where the real money is in Texas. So next question up is from Cecilia. What would be the procedure to raise capital for renewable energy projects and development at national and global level? Cecilia, thank you for your question. The first step in raising funding for a renewable energy project is to identify any subsidies, grants, special provisions available for the project investors by the local government. There are often tax incentives and other supports that benefit the investors. This impacts the return the investor receives. It reduces their tax, it increases their return, and it's something that you want to identify what is available to your investors for the kind of project that you're doing. After that, it's the standard process of identifying the market, the customer's problem, and the solution that you're offering. So you're trying to figure out how to build a standard business and product based on what you're trying to achieve with your renewable project. But the factor that investors are going to be looking for is how is this going to be supported by the community or the governments that benefits the investor or gives a better chance of success to the project. Many will backstop it from total bankruptcy, and they'll do quite a few other things to help the project succeed in order the investors get paid back. So are there any guarantees or other things that could be helpful? That would be great to know. So let's go over and see, are there any other questions at this point from anyone else? If you have a question, go ahead and load it in, and love to get any other follow-up questions to the ones that we went through already. So let's see the QA. So sometimes one of the questions I'm getting a lot these days, in addition to the ones we have here, I have heard some of these before, although I've heard some great new ones as well, is what's going to be the new investment thesis that's coming up? And so one of the things we're seeing is, as we talked about, you'll see a lot of shift toward AI, automation, and robotics. What came out of COVID-19 is the need for very large-scale manufacturing of specific products like PPE and ventilators, et cetera. And when I talk to investors and startups, it's clear that we've offshored so much of our manufacturing capability that that's going to have to come back. And they're going to be looking to be able to source and supply critical products based on our own companies and not other countries where politics and other things come into play. So you're going to see a big shift into that. There's a big move into supply chain visibility systems. You're going to see a lot of companies moving into providing solutions that tell you not only what's coming now, but what can be coming from other suppliers and sources. You're going to see multiple sourcing of products by most companies out there as well. And you're going to see a lot of investors starting to ask you the question, not only is your business COVID proof, but are your customers' businesses COVID proof? Are your suppliers COVID proof? And so you're going to see a new standard coming up that your company can work in lockdown. Your people can work remote. You can continue. You don't have any critical shortages of material supplies or communication, that you have that sorted out. So you'll see that as an investment thesis as well, is that companies that are COVID proof are going to win. Amazon is a really great example of this. They use a high level of automation, fair amount of robotics, they use cloud-based tools all the way throughout. We call that a secure supply chain. Some call that a vaccinated supply chain. It's not going to be taken down by COVID. And robotics and AI, like I say, used to be something that was going to eliminate our job. Well, it turns out that AI and robotics didn't eliminate the jobs. COVID eliminated the jobs. AI and robotics are going to be giving you new jobs. And that's where we're going to see a lot of shift in from old economy into new economy coming up as well. So those are some of the questions we get a lot. And if you're a startup looking for to start a business, I look at supply chain, I look at flexible manufacturing systems, and I would look at other tools to be prepared and think about what was not there in the COVID economy, and think, well, what should we be putting there? Now, you can do things like vaccines, but the one thing you want to consider is there's over 430 clinical trials underway now for COVID vaccines. So the thing you want to consider is, are you unique? Are you doing something that other people are not doing? 430 is going to be a lot of competition, and not everybody is going to make it all the way up there. So one last question here. You mentioned manufacturing jobs coming back to the States. I'm wondering how the process is like. Everybody's talking about using the automated process to manufacture, but there's always a human factor in the manufacturing process. In the US, there's a lack of technicians. I was thinking if there's an opportunity in vocational training. I think the answer to that question is yes. I think just because you have automation doesn't mean nobody's working there. It just means people are working in different roles. Instead of actually putting the piece together yourself, a robotic machine is putting it together, but you have to make sure the robotic machine is working properly. You have to make sure that the equipment's going through the line correctly. You have to make sure that any misalignments or what have you is taken care of. There are certain things that robotics are not good at that people are still going to have to do. So I think you're going to see that there is a tremendous amount of need for working as technicians, as other people. So instead of working on the actual product that's being built, you're working on the machines that are going to be building it, as well as AI systems where AI is turning out to be a very helpful tool in combing through clinical research data, combing through patient data to find solutions for their ailments. And so you're going to be finding that programming is going to have a new vector in the world of AI to manage large amounts of data. And so instead of working at just cutting code, you may actually be setting up data analytics and doing data management work. What makes AI work very well is good, clean data. So if you're a startup looking for something to do, come up with tools that clean up data, make data in a clean, well-structured, usable form by automated systems, because that's where most AI systems are spending their time, is cleaning up their data in order to put it in there. As you look at these new systems, what you'll see is there's plenty of opportunity around those systems in order to make it go. Have time for any more questions? Just give it just a minute more. If you have one, pop it in there. I want to thank you guys for joining us today and look to have you back for more in the near future. I think we have a raised hand, so we'll hang out here and see what the next question is that comes up. We are recording this. We'll post it on our website later. If you want to listen to it again, you'll find that there's information you may find useful for your startup. If you're interested in raising funding, by all means, set up a time to talk with us, and we'll talk about your deal and see what it takes to get your deal to a place that you can arrange funding for your deal. So next question is from Ola. Is there a danger to prematurely discussing Made in America as a product company? There was still limited research on consumer appetite to pay more, and the economic turmoil doesn't make it intuitive. And so the answer to that question is, I think what you're going to find is that the requirements are going up. It used to be that in manufacturing, it's just the cheapest thing you can get from anywhere in the world. What you're going to find is Made in America is going to be a care about that people will put on products, because it won't be shut down for politics, which are always up and down these days. And they will pay the premium that comes with that. The other thing I think you'll see is that the cost of building a product in America will go down, because there's going to be more manufacturing going on. Corporations have offshored so much of manufacturing capacity. There's just very few tools and production capacity here. As we build that back up, I think you'll see the cost will go down and it will become more competitive. Tariffs and other things will also level that playing field a little bit. But what you'll see is that I think in the future, there's going to be a richer, better ecosystem for manufacturing that will make it more attractive. And then next question is, aren't robotics a lot of CapEx? Are investors considering how much more capital is required to tool up for this? Or is this assumption that companies will not be vertically integrated? I think you'll see both. I think you'll see some that will play out and they will want to invest in robotics. The issue is, if you need 100,000 ventilators in a very short amount of time, this is not for everything, but for some products you do need a lot, you're going to have to put in CapEx. And if it's essential or critical, you'll probably find that there are quite a few tax breaks and other government incentives to get the cost down, to get that out there. And the same thing with robotics, as I mentioned before, in manufacturing. Just as manufacturing grows and increases and new technologies come in, therefore the cost will come down. So the same thing with robotics. As we build out more robotics, they will become cheaper, they'll become easier to place, they'll become lower cost to use. And right now, robotics before COVID, robotics, although it was growing, it wasn't growing very fast. It was a very limited space. But now people are seeing that for certain things, it is the solution. And so you'll see investment going in, and it'll be for certain applications. I don't think robotics will be used on everything, but for certain large-scale applications, I think it's going to be a good solution. If you're vertically integrating, then it's also an interesting tool to be used as well. It's too soon to really predict how that's going to play out. But in general, as technology moves forward, cost comes down. The thing is to look for where in robotics, where in manufacturing is cost coming down the most. Is it going to be in the software? Is it going to be in the hardware? Is it going to be in the intersection of all three? I find Amazon still interesting, the way they combine AI, automation, robotics, and cloud-based tools all in one. It's a very interesting model to consider for other companies as well. And COVID is simply pushing things further along. We're accelerating what's already happening. We're not really creating anything new at this stage. Good questions there, Ola. Let's see. So we have one more question from Mark. Given the COVID crisis is disrupting workplace conditions, do you detect any resistance among investors regarding having high-tech talent working on-site versus working remotely? I think we're seeing a shift to working remote for two things. One is it is a safety issue. If people don't feel comfortable coming to work and working together, then they can work at home. And so you have to be, as a owner, you have to be cognizant of that. It's also going to be, to retrofit your office buildings for remote work can be expensive and can be consuming. And so what you'll see is people will find it's just easier to work remotely from home. I think the experience of the lockdown is that people work from remotely and they save time on commuting, they save time on meetings. What I found is a physical meeting moved to Zoom, you can actually cut the time almost in half. What was an hour meeting can really be done in a half-hour meeting because everyone stays focused on the project itself, and then there was no commute time, so it's a tremendous benefit. I think you also see that some companies are going to start using work from remote as a way of dividing up the work, what can be done remote and so forth. You can now have a bigger labor pool. I don't just have to hire people that are within 20 miles of the building. I can hire people anywhere in the US or anywhere in the world. And so what you'll see is that work remote is going to open up for companies a lot more employment options for them that they didn't have before. And same thing for workers. It's going to open up a lot more opportunities for find a job because you don't have to physically drive in. All you have to do is log on and you can start to work remotely there. So I think it's a two-sided answer there. So the next question is from Ola again. Do you think there's a VC shift away from unicorns and instead towards early proof and revenue instead of grand ideas? So there's an article out there, Ola, called Don't Think Unicorns, Think Camels. And the idea is that a unicorn is this mythical, high-value creature that everybody wants that's very, expensive and so forth. But what we really want is a robust company that can withstand changes and COVID economies and viruses and remote work and all kinds of things going on. And so I think what you're going to see instead is you're going to see people that want very solid, stable companies that have some resilience and some robustness behind it so that they are prepared for COVID, and if the lockdown comes again, it won't hurt them, and it won't hurt their suppliers, and it won't hurt their customers. And so you're going to look for ones that are really survival companies as opposed to unicorns. Sounded great to have a great high market valuation, but in many cases, those companies were built on very unstable economics, very questionable business models, and as COVID hit, you saw many of them come crashing down. 1 6-week lockdown and the company's underground, it's probably wasn't a good idea to begin with. And so the last question is, how does this reflect in valuation multiples and target IRR? I think you'll see investors will start bidding up companies not based on market valuation, but on stability. How strong is it? I wouldn't be surprised to see some COVID economic numbers coming up that can measure how much of your workforce is already distributed, how much of your customer base is stable, how much of your revenue is already built into SaaS metrics where it's already been paid for the past 6 months, and you have some time to go find new customers if that's going to be going down. So I think you'll start to see the metrics will go less for size and more for stability going forward. And next question is, again from Ola, do you think minimizing burn is now one of the most important metrics? So I think the answer, Ola, is it depends on your situation. If you've got a very strong cash position in the market, you just raised funding, whatever, then of course you want to keep your burn minimal, but you're probably in a position to go out and grab market share in this economy. If on the other hand, you come in and you find out, well, we really don't have a very strong cash position, well then you have to get to cash flow positive to survive. So minimizing burn now becomes the metric. We have to get to cash flow positive because we're not going to be able to raise money. So it depends upon the status of your business. You're either in a place to grow market share or you're not. And if you're not, you do need to minimize burn. In all cases, I think you're going to see that even companies that are doing well, they are often laying off as well, 10, 15, 20% of the workforce. And what they're doing is using the COVID as an excuse to remove workers that are probably not as efficient as they had hoped they would be, and they're letting them go because everyone's letting people go. And then they may hire some people back, or they may not. Or they may hire different people back. But you're going to see some people, reducing their burn just because they want to get in a very, very lean position, so that when the economy comes back, all that money goes to the bottom line, and now their stock goes way up, their valuation goes way up because they're in a much better fighting position. So the COVID economy, even if you didn't have to lay off, I think many companies did, just because it was an opportunity to replace workers and also get into a better shape. I think that's the questions that we have right now. Any other questions? We'll give you 1 minute, one more minute before we head off, and wanted to thank you guys for coming out today. I think we're wrapping up at this point. Let me check one more thing. I think that's all the questions we have today. Again, thank you guys for your questions. They're really great ones. We will have a recording up on our site next week. Appreciate you joining us today. If you have any questions about raising funding, by all means, let's set up a call. Just drop us a message, and we'll be glad to set a time to talk about your company and your situation and what options you may have as well. So here's our contact details. You can reach me at this email address. And thank you guys for coming today. We'll be doing this again soon, and hope to have you back for a follow-up session as well. And with that, we'll go ahead and close it out.